Good morning. This is Rob Carrig with Carrig Wealth Advisors. Today is Tuesday, March 22nd, 2022. Happy spring to all of you watching this video. I'm going to do a quick 3 or 4 slide update, probably 5 minutes or so would be my guess, to talk a little bit about the impact that market timing can have, the negative impact it can have on client portfolios. I first though want to say, obviously, our thoughts are with those citizens of Ukraine, and we're with them and hoping there'll be some resolution soon to the horrific events we've all seen unfold on television on a daily basis. All right, I'm going to share my screen as always and go through a couple of slides. And let's see if I can do this. Full screen mode. Okay, here we go. All right, the first thing I want to talk about is asset allocation. So it sounds like a fancy word, but it basically just means the mix that people have of stocks and bonds, real estate, small cap, large cap, international, US. Harry Markowitz won the Nobel Prize in Economics in 1990 for his work on the determinants of portfolio returns. I don't know if you can see that or not, but my video is kind of messing it up. Now I'm making it worse. Basically what this means is 91% of a portfolio's return over a long period of time is related to the mix of assets you have. How much is in stocks, how much is in bonds, etc. Other factors such as what securities do you own? Do you own tech stocks? Do you own, industrial stocks? Or when you bought and sold them have much, much smaller determinants in a long-term portfolio. Now, the thing I always like to say here is that's because we don't have a crystal ball. If we knew for sure that it was a good time to get out of the market, get back in and so forth, then we could make 1,000 times our money. Same thing with if we knew for sure these stocks are going to go, up 10x and these are going to go down. But since we don't know that, 91.5% is determined by the mix we have of stocks and bonds and small cap, large cap, etc. So for all our clients, we spend a lot of time figuring out what the optimal mix is of in their portfolio. So when we get into these volatile and emotional and trying times, it's tempting to try to make changes, but 9 times out of 10, that doesn't over the long term help the portfolio's return. This I'm going to make a little bigger here. This is one that I find pretty interesting. Over 20 years, from 2001 to 2020, the S&P 500 was up 7.5%. A mix of 60% stocks, 40 bonds, what a lot of our clients would have, something similar, was up 6.4%. The average investor was up 2.9%. Now, I don't think that's because the average investor had most of their money in, say, cash or something else, commodities, let's say, which have been down. The reason why that is because the average investor, let's see if I can get back to this. Here we go. The average investor tends to follow a path like this sort of roller coaster. They tend to invest at these periods in the market, and they tend to lighten up, sell, abandon the plan at these periods in the market. This slide's great. I wish the slide sort of was inclined so it went up over time, because obviously if things just go up and down over time, then market timing would be the only way to go. The fact is the path over time is up, otherwise none of us would invest in any of this. So it's helpful, I think, for investors to think about, we might be here right now. There's some people that were surprised, nervous, worried, panic-stricken is, I found some client conversations around the beginning of COVID. That's the way I would describe them. And that we now know was one of the worst times to sell stocks. The right thing to do was to hang in there, or maybe even buy more. All right, one more slide I'm going to leave you with. So this will be a quick one. Let's say this is 2000 to 2002 all over again. All right, I know there's a ton on this, but just bear with me. So from 2000 to 2002, the S&P 500 First year was down 9.1, the next year 11.9, the next year 22.1. The S&P 500 actually went down 50% in that period and took a long time to recover. I suppose that could happen again. I hope it doesn't. We don't think it will. But the point is, this asset class blend here, this white part on this chart, this is for investors who had a mix of all of these things, commodities, real estate, bonds, small cap, cash. In other words, what most of our clients own. Investors in 2000 were up 4.9. They were down 1.7. And then in 2002, when the S&P was down 22, we're down 2. Now, I'm not saying that it will be that easy to get through if we have a traditional bear market that might last a couple of years. But I am saying that diversified portfolios don't tend to go down as much as concentrated portfolios that are invested in, 5 or 6 large cap tech stocks, which make up a lot of the S&P 500. So point with all of this is hang in there, try not to make emotional decisions. I know it's hard to do. If we can help, call us, email us, we'll set up a meeting or a Zoom or a call. Thank you and happy spring.